Hello everyone and welcome to my stock channel. This is James with another update for XELA Technologies. Stock ticker symbol XELA. Got up to 7.7 cents today. It was a pretty good day. Let's take a look at the 5-day chart to give you a better picture of what's going on. I did a review of this company and this thing was at 5 cents right here. It had been falling for a year down to 5 cents. It's kind of funny. I bought the stock. It went up 41% the next morning. So I got out, and it settled back down. And then today and yesterday, it just kind of woke back up and 7 cents right around there, 0.6069. What's going on with this company? Why is it so cheap? If you look at the 5-year chart, for instance, you'll see this thing lived in the $300 range. This is a real company. They still do $1 billion worth of business every year. This is their income statement. Oh, by the way, they sell those terminals that they have at stores where you swipe your credit card on it and you check out. They do custom software for certain kinds of businesses to make it jive with their own rewards program or hospital terminals so people can check out. The company is incredibly bloated with operating expenses, $256 million operating expenses. I'm not sure if you're familiar with this type of business, but basically you have salespeople that work on commission. You have recurring revenue coming in from all the credit card transactions that take place at your terminals. They actually give you a cut of the action for putting the terminal into the unit. You get the kickback from the credit card company, and then you get a monthly recurring from the vendor itself. So let's just say if a convenience store takes your terminal to swipe the credit cards, they're going to send you maybe $100, $200 a month as kind of rent for that terminal. And your job as a company is to support the terminal, make sure it's always working, and answer the phone if anything breaks, and just kind of collect the money. This should not be a high cost, high expense business to run. The salesmen are pretty much on straight commission, and if they're not, they would probably be fired if they weren't pulling their weight. The support staff, I don't know how often these machines break, but $256 million a year in operating costs are just absolutely ridiculous. They have 4,000 customers nationwide. Based on their operating expense, I don't know how many dollars that is per customer in operating expense, but you'd think that a team of a few hundred people might be able to handle the support needed for these machines. And you could probably sublet the repair of these machines all over the world if you wanted to. There's lots of ways to not have to carry the burden, the debt, the employees. The company's trying to make a turnaround right now. They got a bank loan today to pay off $43 million worth of this year's debt. So their balance sheet is going to be instantly looking better for 2023. That was some of the good news. People started recommending buy on this one again. They have a new CEO. He promised to cut the operating cost in half in 2023. He's apparently going to attack this $256 million operating expense and turn that into a much sweeter number. It might bring them closer to in the black again. They paid off their 2023 debt. If they, unless they catch up with future debt this year, they might have some extra good numbers for 2023 as a result of that. The dilution of this company is something I was looking at. The shares outstanding, 19 million. They haven't even started diluting this company yet. They could go double it if they needed more money. They could get it right here. Um, they could issue another 20 million shares if they wanted to. It's not like they're at a billion shares or something crazy. That's actually a pretty low number compared to most billion-dollar companies. Um, the price isn't very good for diluting it, but it goes up to 20 cents or something, or 30 cents. It might be a consideration to raise more capital. But it sounds like the new owner is tightening the belt buckle of this company. He's going to slash the workforce. He's going to make it what it is, get rid of the research and development departments, get rid of the stupid operations that are unrelated to their core business, stick with the terminals, stick with the salespeople, lower the cost, lower the overhead, pay off the debt. They'll have a lower debt payment every year as a result, which means more earnings, which means this thing will come hopefully back into the black again. Yeah, so there are some decent looking prospects. They haven't lost that many of their customers. Looks like COVID, when all those stores closed, a lot of them went out of business, probably didn't need their terminals anymore. They kind of flatlined since then. COVID would definitely hurt a business like this, and that was right during their fall. The terminals would have been one of the things that weren't needed in half the country for probably a year, as everybody was closing and didn't need their terminals anymore to be activated. They were probably canceling and not wanting to pay for months, and God knows what these people went through. But hopefully that's over now, and maybe they're back to business. Banks still believe in them enough to give them $75 million they got today. 5 major investors dove in and bought a bunch of shares. They paid off their 2023 debt, and their stock rises. And what is coming in the future, I have no idea. One thing else I was looking at, though, the number, the market cap of this company, $8 million. That's all this thing's worth, $8 million. It brings in $1 billion a year. It's that bloated. Another terminal company that sells, a competitor. Why would they not want these 4,000 customers and just come in and snag this thing for $8 million? They could wipe these people out immediately. I can't see $8 million being the value of these customers. Let's see what the debt is coming along with it. I think they are very debt-ridden. Let's take a look. In 2021, they were up to 1.7 billion in debt. So they're a debt monster. They're upside down. That's probably what the main problem is. But if they whack those operating costs and whack down some of that debt and turn this thing profitable, they could get out of that jam. This thing could turn around. Back before COVID, the year before COVID, they started sucking up debt. That was probably a big investment. Then all of a sudden, it just started to suck, and they closed. It's like the worst time to spend more money. But they were playing ball fair, at least before. Now it's just become an albatross of debt. But it seems like they're buckling their pants and going to make a good go of it, making responsible decisions. The banks believe in them. They have enough cash to get through. Sounds like they can get more cash if they need it. And I like this one more. Somebody just needs to run this place like a normal person. Their books are a nightmare. Go listen to their last earnings report and read it. It sounds like a horror story when you read it. You're like, I can't believe they spend this much money. They have 4,000 customers. It's almost like they have 10 employees per customer. It's really interesting. But anyhow, there's a lot of meat to be cut here, and I think if they actually do the work, this thing here will go nuts. It'll be back up to $1 shortly. But check it out, XELA, Exela Technologies. Thank you. Stock update. Have a good day. I'll see you on the next video.